Welcome to the second week of Intermediate Accounting 2, our second 8-week session. And today we turn our attention in Chapter 9 to short-term operating assets, cash and receivables. It would be difficult to picture a balance sheet without a cash account, and firms love selling for cash. However, most businesses sell the majority of their product on credit. And you might properly ask, why is that? And it is simply because credit is much more convenient for the customer and it greatly increases the volume of sales. So firms then have two really short-term operating assets that they utilize. One is cash, the other is called accounts receivable, or monies that are coming in the near future. As we look at this, we'll see that we have 7 total learning objectives and a brief discussion of each is in order. Our first objective is to define cash and cash equivalents and to describe accounting for restricted cash and compensating balances. Cash consists of coins, currency, and bank deposits, as well as negotiable instruments such as checks and money orders. Together, these are what accountants refer to as total cash. Of course, the majority of cash is in electronic form in data entry systems, not usually in the form of currency or coins. Of the cash that is in circulation, it's interesting to note that over 90% of all paper money is in the form of $100 bills. This may come as a little bit of a surprise to many of you, but that is actually the case. Cash equivalents in counterpoint are really short-term, highly liquid investments with original maturities of 3 months or less. If it's and generally these will be federal treasury bills where we can invest excess cash holdings temporarily for a modest return and with a high degree of safety. Generally, these are considered risk-free. Companies report restricted cash and compensating balances separately from cash, and these are monies that are set aside generally for specific liabilities. Our second learning objective will look at the initial measurement and accounting for accounts receivable, including volume, trade, and sales discounts. Trade receivables are generally measured at the amount of the sale made, and then additional costs such as taxes, returns and allowances, etc., are going to be in offsetting accounts. Trade discounts, of course, are reductions in the catalog or list price whenever a company needs to or sells to a reseller or another business in the same industry. A volume discount reduces the list price for customers purchasing larger than average amounts of merchandise. Sales discounts are reductions in the cash received and sales for early payment. A company can use the gross net method to initially record the receivables. And then as the cash rolls in, generally terms are fairly liberal there. About a 2% discount is customary for early payment. And this increases the cash flow for the firm and makes it less likely that it will have to risk obtaining short-term financing because of cash flow shortages. Under the gross method of accounting, a company records the full amount of the accounts receivable and then records any discounts taken as a contra revenue account, treated somewhat like an expense. Sales discounts is the title of this account. Under the net method, the company assumes the discount is going to be taken and records the net amount receivable. Any sales discounts not taken are then returned into a separate revenue account called sales discounts forfeited. So you can see we have 2 methods for accounting for various sorts of discounts. Our learning objective 3 is to understand subsequent measurement and accounting for accounts receivable, including establishing an allowance for uncollectible accounts. Of course, firms will experience different degrees of allowance for uncollectible accounts depending on the kind of clientele that they work with. Companies report accounts receivable at their net realizable value, also called NRV, which is the estimated amount a company reasonably expects to collect out of its total accounts receivable. There will always be some degree of loss, except in the most remarkable of circumstances. Uncollectible accounts then are estimated and reported in the allowance for uncollectible accounts as a contra asset account, uncollectible, also called bad debts expense. This will increase with the allowance. Write-offs decrease the allowance. Our fourth learning objective is to estimate an allowance for uncollectible accounts using the percentage of sales and the aging of receivables methods, and explaining the accounting for write-offs and subsequent recoveries as they take place under these two systems. I will briefly describe each. The percentage of sales method estimates the bad debt expenses as a percentage of the current period sales. This is based generally on previous experience from previous year's sales. Aging of receivables method estimates the ending balance of the allowance of uncollectible debts by dividing accounts receivable into categories by how long they have been past due. In other words, aging the accounts. The longer the account is past due, the less likely it is to be collected, the more likely it is to forfeit. When a company determines that a specific account is uncollectible, it writes it off by reducing the accounts receivable and reducing the allowance at the same time. If a company subsequently collects a written off account, it reverses the write-off and records the cash collection. Our fifth, sixth, and seventh learning objectives now follow. For number 6, we take a look at the accounts receivable generating immediate cash, including pledging or assigning factoring receivables and seizure and secure authorization, and determining the accounting of these transactions. Accounts receivable are generally what we would call a factorable asset. That is, one can sell them at a discount. There are firms that specialize in buying uncollected accounts. They will then get a discount, and they hope to recover more of the uncollected accounts than they paid out for the portfolio of receivable accounts. Factoring also refers to the risk of accounts receivable. In other words, if the seller transfers the receivables without recourse, the buyer assumes the risk of uncollectible accounts and any credit losses. If the seller transfers the receivables with recourse, the risk of uncollectible and accounts and the resulting credit losses remain with the seller. So there are two types of factoring available. Obviously, the second method is easier to secure because there's less risk to the buyer of the portfolio of accounts. Securitization refers to financing techniques that involve taking many separate and often diverse financial assets and combining them into a single pool or bundle. It's called securitization. We will examine that process. In learning objective number 6, we describe accounting for short-term notes receivable and when issued and after issuance. Notes receivable differ from accounts receivable in that they are generally recorded with some kind of a document listing the parties, listing the dates, and usually listing an amount of interest to be charged over the period of time that the receivable has been authorized as a loan. Accounts receivable generally have a very short horizon. 30 to 60 days is traditional in most industries. Notes, however, can be up to a full year. In recognizing a loan that is now authorized by a note, we look at three items: the face value, the fixed sum of money that is to be received at some date in the future, the stated rate of interest that the holder of the note will receive, and the market rate, which is the interest rate on a similar investment in the marketplace. This helps us to grant proper rates for the stated rates. A company reports a note receivable at the present value of the future cash flows, using market interest rates to do the discounting. And so we turn back to Chapter 7 ever so briefly to look at the time value of money once again as applied here in the case of notes payable. An interest-bearing note requires periodic interest payments over the term of the loan. A non-interest-bearing note does not require periodic interest payments over the term of the note, and the interest is collected at the end when the note is collected. When stated interest is equal to the market rate, the note is recorded at its face value, and the interest accrues over the life of the loan. When the note has no stated value, or the stated interest rate is less than the market rate, two approaches are used to measure present value. If the note is in exchange for goods and services, the present value is the fair value of the goods or services provided. If the fair value of the goods or services can't be determined, we compute the present value as the value of the note discounted at the market rate of interest, called the imputed rate of interest. Notes receivable, of course, can be sold just like accounts receivable. Typically, this is referred to as discounting rather than factoring, as we call the former case. The receivable is removed from the books, and a gain or loss is reported. And our final objective, number 7, is to explain the required disclosures for accounts and notes receivable. Common disclosures include total accounts receivable, allowances, and changes in the allowance. Companies also often describe the elements that influence management judgment and credit risk when estimating the allowance. Other disclosures can include the method used to estimate bad debts and the policy for writing off uncollectible receivables. These, of course, should be stated in the annual report in the footnotes, generally from management. That concludes Chapter 9, Accounting for Short-Term Cash and Receivables. Again, take a close look at the vocabulary, and I will assign a number of brief exercises so you get familiar with handling the types of accounts that accountants deal with in this section. And next week we will continue on. Looking forward to seeing you all in class. Thank you.